market regulators' autonomy. Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar, and with me as always is Sonia Shenoy. Sonia, good afternoon. Market at the lowest point of the day around lunch hour, so looking sluggish at this point. And in fact, Nifty 50 is below the 11,650 levels as well. So at the moment, 0.4% down on Nifty. Sensex in the red as well. It's the mid caps which are taking a biggest knock, 1.5% down. So the broader markets are looking weak at this point, and Bank Nifty is down over 0.5%, and therefore the advanced decline ratio is heavily in favor of the declines, and more than double the stocks in the stock markets which are really trending lower rather than the advances. In fact, Reliance Industries, Axis Bank are some of the big names which have really taken a knock in the last few minutes of trade.
Oh, absolutely, and not looking good at all for the bulls right now. It's this level of 11,730, 11,711 as well, which is the 20 and the 50-day moving average, where the hurdles have come through for the index. So that's proving to be a bit of a resistance. And of course, the results from Yes Bank and Mindtree are the ones that have soured the sentiment the most. What you also have to keep in mind is what's happening with the mid-caps. Once again, there's big sell-off that you're seeing in the mid-cap index, down 250 points as we speak. So an indication that, now the market is smelling that maybe the second half of earnings season will result in a lot more disasters in earnings after what we've seen in the first half already. But onto the top stocks of the day, Yes Bank has slipped to a 5-year low on the back of the weak Q1 performance. In fact, the slippages have come in at a record high there.
Now, Wipro, that one surges on management's clarification that the company will proceed with buyback. Remember, there were some changes in buyback taxation in the recent budget.
And we also have the US FDA worrying the worries that drag Torrent Pharma. The Dahej plant gets an official action indicated status.
And Colgate, that counter surges after an inline set of Q1 results.
All right, well, first up, Yes Bank slips to an over 5-year low on the back of a weak Q1 performance. Several brokerages have cut their target prices for the stock as well, some as low as 50 rupees. Mangalam is here to give us details on all of that. Mangalam, over to you.
Absolutely. Brokerage is not very happy with Yes Bank. We have a handful of them. Credit Suisse has taken the steepest target price cut from above 200 rupees to under 100 rupees. And they believe that the company's low-cost deposit ratios, the CASA, that has declined. And that indicates that there is a pressing need for recapitalization. Their CET1 common equity tier 1 ratio is also down to 8%, and of which 35% is accounted for via the NPA. Provision cover of 43% is still low, and at the same time, they've cut their EPS estimates by 72%. You spoke about 50 rupees on Yes Bank as a target price. Jefferies is the one maintain their underperformed rating with a target price of 50 rupees because they believe the first quarter has been far worse than what they anticipated. In fact, below investment grade book has risen by about 6,500 odd crores. While the management assures there would be capital infusion in the second quarter, the optics, Jefferies believe, look too unsettling. Morgan Stanley has an underweight rating as well. And Nomura, they believe that management's watchlist guidance of close to around 10,000 crores in the fourth quarter seems fairly optimistic, and any delay in capital raising would be negative. They too have taken a sharp cut of the target price from about 230 rupees to 110 odd rupees after a 30 to 50% cut in their EPS estimates. We also spoke with the management this morning, and here's what they had to say.
BB and below book that was there, which was the sub-investment grade book, I think that went up by 6,000 crores. And it's important to recognize that the 6,000 crores increase came only from two names, from exposures to the financial services sector, and which is now reflecting in the MTM that we've taken for the quarter. The watch list of 10,000 crores remains the same. And even though only 2,500 crores has slipped, we continue to look at the balance 7,500 crores very closely. As far as the BB and below book is concerned, that is the one that has grown from 23,000 crores to 29,000 crores, and we think it has now peaked. We don't see a further expansion in this book. On the contrary, as resolutions happen, and we expect at least a couple of those resolutions to happen this quarter, you will actually see that book contract. The watchlist was drawn out of the sub-investment grade book. So these were not two separate pools of assets, and it's important to recognize that. So the genesis of the watchlist really is that what we wanted to do was look at our sub-investment grade book very closely and see where were the potential slippages that could have accrued in the short term. And we wanted to flag those to investors before raising capital rather than doing so post. So it was drawn out of the BB and below book. The BB, and as far as the slippages are concerned, roughly about 2,500 crores have come from the watch list, and the balance has come from the BB and below book. I have enough the PPOP that I'm generating, even in a quarter of consolidation, and it'll only grow from here, is sufficient over the next 8 quarters for me to be able to provide for any slippages that may occur in the BB and below book. Okay. So the capital that we're looking to raise right now is purely growth capital. A basic thumb rule for banking that more capital is better than less. And that's something that we are in very close discussion with investors right now, in terms of what is the structure, what is the size, what is the composition of that capital, and we will raise whatever is needed.
All right, a huge sell-off seen in Yes Bank. They're down over 13%. And the biggest point that has been made by most of the brokerages is about fundraising. And with the now stock trending at 80 levels, it will be very difficult because dilution is going to be very high. But another one which is really reacting to the earnings is Colgate, and surprise, surprise, on the positive side today. And that's because it's in line with the market expectations, and the stock is up over 3% at the moment. Mangalam is standing by to give us more details. So Mangalam, for the consumption basket for FMCG, is the absence of bad news good enough for the markets?
Absolutely, seems like it, because as far as Colgate's numbers are concerned, they're pretty much in line with what the street was working with. 1,085 crores on the top line that the company posted. This compares with a poll of close to around 1,100 crores. Volume growth has also come in at 4%. Expectations were benign, so 4% is what the street was working with as well. The EBITDA has outperformed by a bit, 300 crore versus a poll of 291 crores, and that is where the margin improvement has come by. So the EBITDA margins have improved, and the net profit has pretty much been in line with what the street was working with too. Why is it that the margins were a mild positive surprise? There are 3 reasons for that. One, the company's gross margins were maintained at around 65.9%. Secondly, the realizations came in at 2%. Remember, the sales growth was 6%, volume growth was 4%, so that's telling you that the realization growth was 2%, and the street was working with a number of just 1.5%. And thirdly, there has been a mild jump in the company's depreciation and finance costs, primarily on account of the new accounting norms, so that also has taken the EBITDA slightly higher than what the street was working with. The stock, though, is rallying. There are a couple of reasons for that. One, it has been an underperformer in the past, so it was down 16% from the start of this year. Secondly, there was a bit of valuation headroom as well, because the stock trades at 38 times as against the FMCG sector valuations of close to around 41, 42 times. And thirdly, it went into the numbers slightly expecting bad news, and absence of that bad news took the stock price higher. The only missing tooth in Colgate's numbers is the market share data, which the company has not reported over the last 3 quarters along with its results. So that is something we'll be watching out for to see whether the market share has come down or they have gone ahead and grown their market share.
Okay, Mangalam, thanks a lot for that. So how much ever the slowdown, people are not going to stop brushing their teeth, right? That's what Colgate indicates. By the way, Colgate is still an expensive stock, as Mangalam was telling us, 38 times FY20. And there's a relief rally seen across the consumption space with respect to expensive stocks. So whether it's a Britannia, whether it's a Page Industries, Colgate, all of them are rallying this afternoon. But staying with the earnings, then Wipro surges despite a weak Q1. The management says that they will go ahead with the buyback. So despite the weakness in numbers, the buyback is keeping it afloat. Rima is here to give us more details on that. Rima.
The stock is higher despite weak numbers on the back of the buyback news, because the management has clarified that they will proceed with their 10,500 crore buyback. They have written to SEBI. They are awaiting clarification if this 10,500 crore of buyback is inclusive of this 20% tax, or the taxes to be paid over and above that amount. Now, if the buyback amount includes the tax, then the amount that the company will be spending on buying back shares comes down accordingly, and therefore the number of shares they will buy back. And therefore the question is, will another shareholder approval be required, because now effectively you're buying back less? So all these questions have been put forth to SEBI, and the company is awaiting clarity. But they said either way, even if we have to pay tax over and above the 10,500 crore amount, we have that kind of financial reserve, and therefore we are going to go ahead with it irrespective. That's the reason why the stock is higher. But I just want to put on board that this was a major overhang on the stock, because now I'm comparing it to the pre-budget levels, and it's still down close to about 6.5%. A quick run through of the numbers. As we've been saying, it's a weak performance. Revenue is down 1.8% in dollar terms on a quarter-on-quarter basis. Adjusted revenue is down 1.3%. Constant currency revenue has also declined for the company by 0.7%, which means it's come in at the lower end of the company's guided band. Margin performance at 18.4% look better, but then on an adjusted basis, it's only about 18%. The problem is that BFSI started slowing down for the company. It declined this quarter on the back of weakness in capital markets as well as a couple of European banks. And considering that BFSI was the bedrock of the company's growth last year, the slowdown is a bit worrying. Brokerages are a bit disappointed with the numbers. So Citi trims their EBIT estimates by 2 to 5%. Their target price now stands at 250. Jefferies has an underperformed rating, target price 225, but they believe that even at current valuations of 15 times FY21 PE, the stock is overvalued. Credit Suisse too has moderated its growth estimates for Wipro.
BFSI, I'm quite confident that Q3, Q4 it should rebound. On manufacturing, the US manufacturing is looking good for us. The continental Europe manufacturing will take some time. By Q4, I would guess. I would not hazard a guess on what happens with the HPS platform around the Affordable Care Act, simply because the political uncertainty can't predict when this will be back.
Only priority right now is to catch the momentum on the growth side, and for that we remain invested in big bets. We'll remain invested in the things that we need to do to catch demand in right areas. We will also have right investments that we need to make in geographies and so on and so forth. And on the other hand, we'll have to remain very, very focused on efficiency gains that we can bring out. Headwinds are in form of exchange. Headwinds are in form of 2 months impact of salary that we have given in Q1.
All right, so that was from the IT space. In fact, staying with that particular space and earnings-related reaction, there's Mindtree next on our minds at the moment. And take a look at that counter. It has really been knocked down by over 8%. But the real picture comes in the 1 month chart, 7-day chart. If you see consistently, there has been a fall because of several reasons, not just the earnings. Remember, L&T's open offer for Mindtree was at 980 rupees. The stock is down substantially in the last 1 month. In fact, Reema Tendulkar is right here to tell us all about the Mindtree earnings and why is there a weakness on the counter as well as the margin front. Reema.
Well, it's an all-round miss by Mindtree this time around. Revenue growth has come in lower than estimates at 1.1% in constant currency terms. Dollar revenue growth too, if I look at it on a year-on-year basis, has now moderated to high single digits at 9.6%, much lower than this 15-20% growth rate that it enjoyed. So clearly, this whole L&T bid, the management was distracted, and it seems to have impacted their execution. Margins are the weakest point in the numbers. EBIT margin 6.4% at all-time low. EBITDA margins at declined by more than 500 basis points to 10%. There was this one-time special reward given to employees, which impacted their margins. If you look at the internals, the only positive is the deal wins, which stand at record levels, but attrition is a worrying point. The company has scaled down its FY20 guidance. Now they're guiding for just above industry growth, and even on margins, they're just guiding for a marginal improvement in their margin level versus 100 to 120 basis points improvement earlier. The problem is that uncertainty still persists because the new CEO, as well as the whole tier 2 management, the top executive management, is yet to be appointed. Sharp cuts by the brokerages. So Kotak cuts it by 15 to 21%. Macquarie lowers it from 21 to 26%.
Okay, that's been one of the other big stock of the day. Let's take a short break on that note. But on the other side, the US FDA woes drag Torrent Pharma lower. We bring you more details on the other side.